And thank you, yes, for having me. It's a great pleasure. I see that you have exactly the bad weather that we have in Johannesburg as well. I was looking forward to a sunny day in Durban, but that's not the case. So talking about improving the quality of the financial statements. So as an opening remark, I want to emphasize that as finance professionals, we need to be moving beyond just counting the beans. We should actually be telling a story. And we need to move beyond a compliance phase for preparing financial statements and put passion and excitement back into preparing financial statements. And I really want to emphasize that our job is to tell an entity's story. And the same sentiment applies to the annual report. I heard a lot today about trying to understand evidence-based policy making. What I'm going to share with you today is actually some of the observations that we did from our own monitoring and evaluation analysis. The other thing is really trying to make sense of all of the information that we publish. I saw a little earlier, the speaker was talking about the integrated development plans. Now, how do the financial statements fit into that? So I really think that there is a clear storyline that we need to tell between having a plan, having the resources for the plan, which is the budget, actually executing the budget, the financial statements, and then we have the performance information. That's the story that we need to tell, and that's the story that we need to start telling in the financial statements and the annual report. We're not just counting beans anymore. So just to say that these views in the presentation are my own. Of course, they are not the official views of the ASB on any technical matter. But let's unpack what good financial statements could be. So this is quite a simple slide, just to take you through what, in my mind, what high quality financial statements will provide information that is relevant, is a faithful representation of certain things, they are understandable, they are verifiable, they are comparable, and they provide timely information. So if these look familiar to you, of course they are familiar. They should be, at least, if you read the conceptual framework at all. These are what we call the qualitative characteristics of financial statements. And these are the things that we need to strive for when we prepare the financial statements. So let's unpack each of these in a little more detail. So firstly, what is relevant information? So relevant information means that the information is capable of making a difference in financial reporting, either because it confirms certain things or it predicts certain things. So if we think about confirmatory value, if I, for example, am intending to hold officials accountable for certain things, information that will hold those officials accountable will be relevant to the understanding or to the users of the financial statements. Equally, predictive means that it provides information about the future and what would happen for the entity going forward. When is something a faithful representation? This is when the information is complete, it is neutral, and it is free from error. Simple things. Complete doesn't mean, it means that all the information is provided about an item, but it doesn't mean that it's completely accurate. Of course, we do know that there may be errors in the financial statements. What we are really looking here is the informational value is complete. So if you think about something like the financial statements, we have the components of the financial statements, but we also provide the disclosure notes. Those two things together provide you complete financial statements, and it's important that those two things talk together. Neutral means that the information is free from bias. So bias is, of course, the judgment that we would put into preparing the financial statements. We are eternal optimists, of course, but we need to be prudent when we prepare the financial statements and make sure that we are not putting forward just the rosy position that we would like. We, of course, need to be neutral and balanced in our views on what we put forward. Free from error, we do know, of course, that there may be errors, but we are looking at free from material error. So this means that there are no errors or omissions that would affect the decisions that users are going to take. Understandable information, and I'm going to pick on relevant and understandable information in the next parts of the presentation, but really it's that it can be comprehended by users. We find quite often that the financial statements are really difficult to understand, and even I find them difficult to understand, and I am familiar with the jargon. So what we need to do is really make sure that yes, we do need to make assumptions, of course, that users are assumed to have a knowledge of the entity's environment, so we're not starting from scratch, but they also need to be able and be prepared to use the information. But I'll give you a couple of tips on what I think understandable information is. Information needs to be verifiable, and note that I didn't say auditable here. I said verifiable. So verifiable is that whatever conclusions you have come to in your financial statements, you are able to produce information so that other people would be able to pick up that set of financial statements and come to the same conclusions as you. That's it in a nutshell. So we do know that we apply judgment when we prepare the financial statements, which means that it is possible that we come to different conclusions on different matters. But what's important is that you provide information to the users so that they are able to understand and come to reach the same conclusions as you. Information should be comparable, and note here that it's not consistency that I've used, it's comparable. And this is exactly the idea that we don't strive for consistency in accounting. We strive for like things being treated in the same way and different things being treated differently. So when we talk about comparability, that's also information that we need to be providing in the financial statements. So we find quite often, particularly when it comes to audit time, that everybody just wants to have the same answer in the financial statements for a transaction that's sort of labeled in the same way. But actually the underlying facts and circumstances could be completely different. So that's where comparability is important, so that you describe exactly how you came to a conclusion about a particular transaction, so that users across provinces are able to pick up the financial statements and understand why there are differences, particularly when it comes to treatment and recognition and measurement. The last one is timely. I think this is self-explanatory. I think most of our legislated deadlines prescribe the deadlines for information. But I will touch on something when we come to the effective dates of the standards, where I do think that having timely information is helpful. So as I said, I'm going to unpack two things that in my mind, will go a long way to improving the quality of the financial statements in terms of relevance and understandability. So what I've explained to you on the last slide is, of course, a technical understanding of what relevant is from a conceptual framework perspective, but just think simply about it. When is information going to be relevant to the reader? When it targets the right people, those people get the right information, and thirdly, that they use the information in the right way. So it's very easy when we are preparing the financial statements to get into a mode of just wanting to comply, wanting to get the financial statements off my desk onto somebody else's desk, usually the auditors or your manager or whoever it is that's going to do the next review or the assurance, that we sometimes lose sight of why it is that we are preparing financial statements. And don't get me wrong, I completely understand that. I'm also involved in preparing our entity's financial statements. At some point you just think, oh, I just want to get this done. But you need to stop and you need to think, why is it that I am doing this? And are the people that are going to read this really understand what they are looking at? So if we have a think about the private sector and who the users are in the private sector, I always like to use this analogy because it's really easy to understand. If I'm a company, I go to somebody external, they give me funding. The expectation is that I would give them either a return on their capital or be able to return their capital. But I have a very strict user group. In the public sector, it isn't like that. It isn't like that just because we have such a broad user group. We have taxpayers, we have ratepayers, we have donor agencies, although not USAID anymore, but there are others, of course. We have international funders. We have a range of people that contribute towards the resources that we have as government. More importantly, we have people that rely on government services that may never contribute a cent. But it's important that they are included in this user group because they are the ones that would potentially want to make decisions about government services, where they could live, which municipality they would like to be located in, etc. So it's important that when we are effectively managing the resources that we're given and how we have executed that against the budget. And again, very clearly, the budget is the spending authority, the financial statements is how we spend, so we need to make that link very clear. Information about liquidity and solvency. Liquidity, can I pay my creditors and other debts within the next year? Solvency, how do my assets and liabilities look relative to one another? Very importantly is that while the financial statements do not provide direct information on performance, non-financial performance that is, and sustainability, it gives us an opening window to what sustainability could look like. Because sustainability starts with the financial statements and it gets projected forward, it gets linked to our non-financial information. So our financial statements need to start telling that story, and the annual report needs to continue that. Probably users are also going to be interested in the use of the current year's resources in terms of financing operational issues. So we know that we shouldn't be borrowing today for our operational expenditure. So did we actually use this year's revenue to fund our operational expenditure and other activities? And this is really where concepts like intergenerational equity are important, particularly at a municipal level. I know that the public entities wouldn't concern themselves too much with that. But really understanding whether or not what we got in this year is actually what we spent, or are we spending it from other resources? And if yes, getting a clear understanding of that. Cash inflows and outflows, and then of course any other information that users would find useful. And I think the last point is really critical, because the standards do say that as much as we prescribe who the users are, what we think the decisions are that they're going to want to take, your users might want other decisions. It's up to you to decide whether or not that fits within the realm of the financial statements or not, and if they want that information, provide it. I walked in probably halfway through a presentation talking about stakeholder consultation. How many of you know who your users are of your financial statements and what they want? Anybody? Do you ask them? Do you speak to them? No, heaven forbid, we don't talk to them. This is really critical. If you, without being too conceptual and philosophical about it, if you look at some of what corporates are doing around integrated reporting and integrated thinking, the number one requirement before you've done anything is to find out who your users are and to talk to them. So it's not a bad philosophy to take into our government financial statements and do exactly the same. We do, of course, know who some of our users are by proxy, but if there are other users, find out who they are. Talk to them. I'm sure they don't bite. So if we move on to, I've spoken conceptually really about trying to find out what the right information is in your financial statements. So how can we make this practical? Because if you think about, we process so much data over a year, arguably all information is relevant to users in some way, shape or form. How do we make sure that users have the right information to make the decisions? It's up to us to highlight to them what is most important by the way we present, by the way we account, by the way we disclose the information. So I'm sure you've heard about the concept of materiality. And this, for me, is the one thing that us as finance professionals are not applying properly, if at all. We do annual reviews of financial statements on various topics. I'm sure you've seen some of them on our website. But we often find that CFOs and others are just not applying materiality. I think it's partly the auditors as well. I think everybody's too scared to leave something out, but it's because we don't have a clear understanding of what our users want and why they want the information, and this is why we tend to just throw everything in there and sort of hope for the best, like a shotgun approach. We have to apply materiality better. So just to go through the definition very quickly, it's omissions or misstatements of items that are material if they could, whether individually or when they are combined, influence the decisions or assessments of users. We've spoken about who the users are, made on the basis of the financial statements. Materiality depends on the nature or size of the omission or misstatement in the surrounding circumstances. The nature or size of the information of the item or a combination of both could be a determining factor. So I'm going to just flip to the next slide quickly. So this is how we think about applying materiality. If the diagram looks familiar to you, it comes from our materiality guideline. It's not mandatory for you to apply, but you have to apply materiality when you prepare the financial statements. So it's a good idea that you at least have a look at the guideline to understand how you should be thinking about materiality. So remember when I said firstly, who are your users? You cannot apply materiality if you do not know who your users are. The second step is what information do they want? What is their information need? And these two things are absolutely critical when it comes to preparing the financial statements, regardless of where you sit in the sector. Once we have those two things, we can then have a look at deciding what I guess the parameters are that are going to be useful for me to decide whether or not something is material or not. And we have two types of parameters: quantitative, money, R, ZR, ZAR, and then we have the qualitative thresholds. Now that's a bit fuzzy because that's going to be based on judgment and what is really most critical to your users. So importantly, from a public sector perspective, we place as much weight on quantitative and qualitative, and you have to have a look at the two of them together. Sometimes something can have like no rand value, but it's highly material from a qualitative perspective because it could, for example, deal with relationships. So if we think about related parties, a whole lot of what happened in state capture, the rand value of some of those transactions might be zero, although that's not the case for state capture. We know it was billions. But there were relationships around many of those transactions where the qualitative characteristics made them important to disclose from a materiality perspective, regardless of if there were any transactions or not. So we are going to determine what is material from a rand number or from a qualitative perspective, and then we are going to develop our parameters. We call them quantitative thresholds or qualitative considerations. That's the bottom block in the middle. So how does this affect our financial statement preparation? If we then move on, all the way onto the right-hand block, how do we apply materiality when we prepare financial statements? Usually people tell me we get these calls around March, April, May, sometimes into June. I disagree with my auditors because I say it's material and I say it's not material and they say it is, or it's the other way around. It's very difficult for you to argue with auditors at that point in the year because firstly, nobody is thinking clearly. Everybody just wants to get the audit done. So generally you'll make compromises and say, okay, well, I'll just do it. Or you'll argue because you don't want to make the change because there's some consequence for the audit opinion. But we need to think very carefully when we prepare our financial statements about how we are going to put them together. They shouldn't happen by accident, right? So we should be starting very early to develop a materiality framework that will very clearly indicate what our accounting policies are going to be. How we are going to present information in the statements. So what line items am I going to put in the statements? What am I going to put in the disclosures? Importantly, I'm also going to have a framework that's going to talk about assessing omissions, misstatements, etc. I mean, I'm not going to, if the auditors find certain things, change everything. I know that's been if you talk about the whole of government consolidation, I guess that's what they do. But really, we need to be mindful when we prepare the financial statements, just like we are with everything else that we do. So a couple of things I want to talk about with materiality, because there are a number of misconceptions. We do have a fact sheet. I'm sorry I didn't put the link on our to our website, but you can find it. We have things called fact sheets, and we have one on materiality. So generally, when I talk about materiality, everybody says, but then why do we argue with the auditors? So firstly, we are looking at materiality with this definition in mind. So when is something in my financial statements going to affect the way that users take decisions? And if something that I have or have omitted from the financial statements affects their decisions, then it is material. The auditors are really looking for material misstatements. So as much as materiality is defined in the same way, how it is approached and used are different. So what I'm asking to try and help you get away from arguing with the auditors, it won't always happen, of course, is to prepare a materiality framework. And as I said, the financial statement shouldn't happen by accident. There should be a very clear direction of travel throughout the year. Otherwise, you're not going to be able to collect the data. But have something clear in mind about what you think is material based on the transactions that you have, how that affects your accounting policies. So, of course, if you pick up a template from one of the software companies, you'll have accounting policies that will be about 50 pages long. That's not all relevant to you, so take it out. I use the ASB as an example. We're a Schedule 3A public entity. We're wholly reliant on a transfer payment from government. So the only revenue accounting policy we have is very short and explains exactly how revenue affects our environment and how we account for it. Take out all the other stuff, that's irrelevant. Decide then what is material from a statement perspective, so what you want to put on the statement of financial performance position, all the other statements, and then decide what you want to present and disclose in the notes to the financial statements. And this should really be your driver throughout the year. As you get to understand more about the accounting standards, perhaps you have new transactions that happen during the year, you adjust your materiality framework. And this is something that you can take to your audit committee, to your finance committee, whatever governance structure you have that deals with your financial statements, and the auditors can be part of that process. They can have a look at what you are putting forward, and one would hope that they would say, look, I disagree with you, or whatever the case is. But at least then you have a really good starting point for saying, this is why I prepared my financial statements, and this is how they look the way they look. We're not arguing then about something in June. They've then had an opportunity to do that. The other thing that I just wanted to touch on is I know that public entities do prepare a materiality framework from a PFMA perspective. That's really meant to drive your reporting with your executive authority on certain transactions, usually legislative transactions like sales, etc. Sales of assets or restructuring of your entity. So there's no harm in having a materiality framework that includes both of those things. So you can have a separate document, it can be part of the same thing, but the ones reporting to your executive authority on certain things, the materiality framework that I'm talking about is one that's going to drive the reporting in your financial statements. And as I said, I think really if you can start this process early at the beginning of the year, agree with your auditors what you think is going to be material or not, hopefully we can stop the fighting in June or later if you're a municipality. So when is information understandable? And I started off my presentation by saying we can't just be bean counters, we need to be storytellers. So I went to a conference last week and somebody said, why is it that children don't know about accountants when they are young? They want to be a fireman or a policeman or a doctor or something like that. It's like, yeah, well, if we're calling ourselves bean counters, we're not really doing ourselves much of a favor. So I like to tell people we're storytellers. We're not just bean counters anymore. So we firstly should not be reproducing what the standards are saying in the financial statements, because that is really boring. I can't tell you how many financial statements I read where I can tell you exactly what the PPE accounting policy looks like. Property, plant and equipment is and it feels like I'm at a recital of a poem by a kid. So it's the same thing. And I know where it comes from. It comes from using templates. So I'll talk about that in a minute. But yeah, we need to move away from that. We understand what our transactions are. Let's use our own language. So let's be simple. Let's be concise. Let's minimize the accounting jargon that we are using. Let's explain the application to the entity, its environment, and its transactions, and avoid using the boilerplate wording from the standards, please. So just a good thing to mention, I do know that many organizations use templates, the accounting software that produces your financial statements. I know that you can tailor many of these things because we've had meetings with the service providers. I know it will be a pain to change it, but just do it 1 year. Change the wording, that standard wording, and make it relevant to your entity, please. It would really increase how the financial statement or the number of times it is used and how it is used. So I know exactly why you use it, but invest the time to change the boilerplate policies, and then every year you just update it for what's new. But really make the investment in, if you use a template, make it your own. At least, please. Okay, so a couple of steps that you can take to improve the quality of the financial statements. Start early, please. This is not just a year-end process. I think I did make that very clear. What we really want is this ongoing sort of understanding of what the financial statements might look like. So we're thinking about it throughout the year. As I said, it doesn't happen by accident in April and May when we are submitting, or of course in August if we're municipalities. Set materiality, develop the materiality framework, monitor it during the year so that you make appropriate changes. Prepare for changes in advance, and I'm going to talk to you in the next slide about that. and really make sure that your policies, processes, and systems support the new or amended standards and changes in the operating or regulatory environment. So, I mean, it's very hard just knowing that systems produce information in a certain way. If you are not sure what the accounting is going to look like until a year after the fact, it's very hard to get that information from the system, if at all. Or it's going to be very expensive or time-consuming. You're going to have to extract it and do all sorts of things with it. So save yourself time and prepare in advance. I think many times we make life difficult for ourselves because we aren't prepared enough, and we have to go to sort of extreme measures to put the financial statements together, whereas if we just started early, we would be able to prepare better. So I'm going to pick on the new financial instrument standard as an example. So for those of you who don't know, I hope you do, that there's a new financial instrument standard. It's effective from 1 April 2025, which is about 30 odd days from now. So I'm going to use this as an example of just change the thinking and change the behavior. So the transitional provisions require retrospective application. So you have to apply it for all the things that you still have on your balance sheet. You don't need to restate the comparative information. You're going to make the change in the year that you adopt. So 1 April 2025, you'll change your accumulated surplus and deficit. But obviously you need all the past data to do that. So generally, when we see the effective date as being 1 April 2025, you think, okay, don't worry, it's fine. I can wait until 31 March 2026 because that's when I'm going to prepare the financial statements. And then it rolls even more forward because then you think, okay, well, I'm only preparing the financial statements in May. So that's okay. I have until May 2026, so we're okay. I have time. But actually, what you need to do is already calculate the impairment as at 1 April 2025. And you should have calculated the impairment for what you had previously. Plus, you need all the opening balances as at 1 April 2025. So unless you know what is happening on 1 April 2025, I don't know how you're going to prepare your financial statements in May 2026. So this is not to scare you, but it's to give you an understanding of, particularly if there are standards that require retrospective application, you cannot wait until the year in which you need to actually prepare those financial statements to put together the information. You have to have it now already. So yeah, 31 March 2025, you have a couple of days to get ready. Are you ready? No. That's a little scary. But the reason I wanted to emphasize this as well, this is something that's totally overlooked when we prepare financial statements. You know, there's that part of the accounting policies that says that you need to disclose what standards are effective and not yet adopted and what the potential implication would be. And we all just write the list of the standards and we say, okay, I've done that. But that's not the requirement in the standard. The requirement of the standard is actually that you disclose. I'm not going to go through all of it in the interest of time. We do have frequently asked questions on this. But it's really that you understand what the changes are going to be to the financial statements in future periods, and you start disclosing that information. Now, why do I do that? So that I have predictive value, right? We don't want there to be these huge changes in the financial statements that people didn't expect. I know already that I need to apply financial instruments. I know what the effect is, so I need to start disclosing that in my accounting policy note. That's what the note is for. But if we understand what the note is for, then we can have better information in the financial statements. So I hope that you all heed my warning about financial instruments. I'm going to talk a little bit about it now. But I think the point more broadly is that we need to prepare more in advance when we want to prepare the financial statements properly. We cannot wait until the submission deadline to start scrambling to get all the information together. You'll probably not be able to see this now, I'm sorry, but you'll be able to see it on the presentation, which will be distributed to you. So our website is our primary communication tool, and I thought I would just give you a couple of highlights of where you can get information about accessing changes to the standards, useful tools, etc. So firstly, under the GRAP tab, I've tried to circle them. You will find Directive 5. This will explain to you what changes are coming ahead. It will firstly tell you what all the standards are that you need to comply with, standards, directives, guidelines, etc. and then also tell you what you don't need to comply with, because there have been entities that now want to add in all sorts of other things from other reporting frameworks, which is not okay. It will really explain to you what it is that you need to do. So firstly, Directive 5, you can find it there. And we have a couple of different resources that you can look at, including a communication that we do send to all PFMA and MFMA CFOs. So you should be getting that communication. Something new that we've started is supporting the adoption of the standards. And the one particularly that we've started with is financial instruments. It's the most critical one for us in the next couple of years. You'll see more things added here in the future. It's just that we had to start somewhere, and financial instruments is it. The other one is enhancing the application of the standards of GRAP, and you'll see there's a couple of things there. If you click on those, you'll see there's a couple of different items in each of them. And that's really YouTube content that we have created. So if you can't sleep at night, YouTube, ASB, I'm sure it will help. If you're stuck preparing your financial statements, it's also a good resource. So don't let it put you too much to sleep, because it might have an adverse effect at work. But I think what we have heard a lot from our stakeholders is that, reading is difficult for all of us. Sometimes it's easier to just have somebody explain something to you. So the idea is not, so some of these are our webinars and the longer sort of PFMA updates that we have, but most of them are really short. We've tried to keep them between 10 and 15 minutes, and they deal with topical issues that will help you prepare the financial statements. The other thing that we have recently launched is a GRAP Knowledge Hub. I don't know how many of you attended the launch. It was about 3 weeks ago now. So this is a joint initiative between ourselves and the Office of the Accountant General at the National Treasury. Everything GRAP related you will find in this one place. And I think that's one of the key messages that both the OAG and us were hearing, is that it's difficult to find all the information that's available. People don't know if they must come to our website. They don't know if they must go to the OAG's website. So we've tried to put it all in one place. So what you will find is everything that's on the OAG's website will be here. Everything that's on our website will be here, including things like newsletters, social media posts, etc. Because I think we have a lot of good information on social media, but it also gets missed. So everything that we have will be on the GRAP Knowledge Hub. It is free. You don't need to be a public sector employee, a public servant, or whatever it is. You can just access it for free. It will be updated every 2 weeks. But yeah, everything GRAP related, that's your one-stop shop. We're trying to promote everybody using this just to get rid of the sort of fragmentation of where information is available. I'm going to stop there before I go into the more technical part of my presentation, because probably that might put many of you to sleep. Any questions? Okay, and no one. There's one there. No, I'm going to take a few questions. I do have a little bit more to go, but I'll rather take some questions on this before I move into the more technical part of the presentation.
Okay, thanks, Jeanine. Well, mine is first a comment and then a question. When you were presenting this quality of AFS, you talk about this relevance, fair presentation, and I was just reminded about the story of Steinhoff.
Yeah.
And I'm trying to understand what is it that was missed in these sort of most important things by the people that were reading the financials of Steinhoff.
Good question.
And then, secondly, I'm sure you will notice in the audit outcomes, the AG will normally present sort of misstatements before the audit and then after the audit.
Yep.
And I'm trying to see what role you as SAP now can you play using AI in terms of, I mean, what are the major things that AG picks up every year in those sort of misstatements that they have to correct only after they have done the audit? Isn't there something that you could help us so that we don't miss these misstatements? I think for now I've got those two questions. Thanks very much.
Okay. So of course, Steinhoff is luckily not, as the saying goes, not my monkey, not my circus, but I'll give you an understanding, I guess, of where I think some of the issues arose. So let me just go, I'll leave that. But I think if you think about materiality, so materiality it talks very clearly about omissions and misstatements that could affect how users would take decisions on the financial statements. And I think, knowing that, of course, Steinhoff is not concluded by any stretch of the imagination, but I do think that management was hiding things. And I think they knew that there were going to be certain things that were going to be relevant to users of the financial statements, and they didn't disclose it to the extent that they should have been. So one of the things, if you get into talking about materiality, is that you shouldn't obscure information. And this is the thing that worries me a lot about the financial statements in the public sector, is that we dump information in the financial statements. And I don't know if it's intentional or if it's just because that's what the financial statements are. They become a dumping ground for everybody's things that want to be audited. But it's very easy, if you have complex transactions, if you have a lot of information, to hide things in the detail. Firstly, it might be there, but nobody pays attention to it because there's 100 other things that they need to focus on. Or very clearly, you are classifying things or rolling up things into a single line that will obscure information from the users. So, of course, I think that's partly what could have happened at Steinhoff. It was a hugely complex organization, so I think it was very easy to hide what the truth was at times. So your question about the misstatement of the financial statements, and so this is one of the things that the trilateral parties, and that's ourselves, the OHG and the HSA, engage on. Is getting to understand what the misstatements are, and if some of them really need to make their way into the audit opinion, because some of them are genuine errors. It's not such a big issue. But if there are recurring things that happen, and they happen year on year, then those are the kinds of things that, of course, could potentially make their way into the audit opinion, and I think are at the moment. So in my next interaction with them, I'll commit to having a discussion with them about what are the kinds of things that they see the adjustments being, and if there's anything that we can do to issue guidance around that, either between ourselves or the Treasury. But I think it's a really good point. I think our focus to date has been, please, let's not report this as an issue if it's really just a mistake. But yeah, we do know that there, of course, are issues around the submission of the quality financial statements to the auditors. But yeah. Are there any other questions before I... Anyone online? Okay. I'm going to start with, I see I have about 19 minutes. I'm not going to use all that time. I really just want to focus on, seeing as you are going to get the slides, I just want to focus a little bit on financial instruments. Can you start on slide... Sorry. Can we start on slide 34, please? Don't worry, I'll move it on. So I do have a section in my presentation that deals with, the financial statements, what changes are in effect now for 31 March 2025 and then going on. You'll see that we're giving you a holiday this year. Lucky you, nothing this year. But then next year we have financial instruments, which is big. And then just all the way on the right-hand side, the process is that the minister approves the effective date of the standards. We have a long list with him at the moment. It just now keeps moving out more and more as the minister, the approval date is delayed. So, just keep an eye on that. Obviously, you need to include some information in the financial statements around that. You wouldn't be able to complete all of it because you don't know the date. But there is an expectation that if the standard is available publicly, that you are at least aware of it. You understand what the changes are so that when the effective date is announced, you would be able to adopt it. Let me move to financial instruments quickly. So again, getting ready for financial instruments. Can I just ask quickly, how many of you are public entities? All municipal entities. You're not sure. Identity crisis. Provincial departments. Okay. All right. So if we have a look at financial instruments, then what's really important is, firstly, to plan early. As I've showed you in the slide, you should already have this information available. But really what is important is that financial instruments doesn't affect all entities equally. So if you think about municipalities, particularly the metros, they would have really complex financial instruments. They would have loans, they would have consumer debtors, they would have creditors, they would have a whole lot of things. So the whole standard is applicable to them. Then you get public entities like us, where we have a bank account and we have creditors. We don't even have debtors. So, you need to be able to scale the standard so that it's relevant to you. But therein comes the judgment. You need to understand who your users are, what you have, which is the first problem, and then trying to make it relevant to them. I cannot tell you how many times we pick up financial statements and it's a public entity, they have nothing, and then there's like 5 pages of financial instrument disclosure, and you think, what are you doing? There's no way that this is going to be relevant to anyone. So think very clearly about when you prepare the financial statements, what is going to be relevant. Just to talk, I'm not going to go through all of these. I think just to say that the change, we do adopt international standards here and we adapt them to our own circumstances. So internationally through the financial crisis, which seems like a distant memory already, there were a couple of things that were identified where financial instrument accounting was really not giving us the right results. So just broadly, 2 things. The one was the overuse of fair value, particularly for financial liabilities. And the second one was really having a look at the impairment approach and that the impairment information was too late. At that stage, we were only reporting impairment losses once the event had actually occurred. So it's like the same with, if you reverse your car into a wall, that's the impairment. Same for financial instruments at that point in time. And it just wasn't giving us the right information. So the changes that have been made, I'm not going to talk too much about scope because I don't think that will influence you too much, although even at a departmental level it could. The classification is a little different about when you use fair value in particular, and then secondly, the impairment model is totally different. We actually have a look at what we call an expected credit loss model, which is really what you think what your exposure is to credit risk for particular debtors. So just to start very quickly with financial guarantee contracts, I'm not going to talk about the accounting in any great detail, but just to say that financial guarantee contracts, so where I have a contract with somebody else and I guarantee that they will pay their debt instrument. So if they have a loan, I stand good. Government does this quite often. Is to say, if they don't pay, I will step in and pay you. Usually there's a fee that gets charged to issue the financial guarantee to me, the one that issued the guarantee. Those things are now financial instruments. We previously dealt with them in the provision standard, but now importantly, they are in financial instruments. So it could be that it's relevant to you. I know from a departmental perspective, I think those things are in the annexures. I think you still deal with them as contingent liabilities, but from a GRAP perspective, they are now fully financial instruments and should be reflected on the financial statements. Just to clarify that it's the issuer. So if I issue a guarantee, obviously I have exposure to credit risk then on my balance sheet, so that's what I'm accounting for. If I have a guarantee, it doesn't matter. That's just something I disclose. Quite importantly is that, particularly if you have oversight over entities as departments, the classification of your financial instruments could be different. So one of the key ones that I want to talk about is particularly between amortized costs. So some things that may have been amortized costs might actually now be fair value. So you'll need to have a look at those very clearly. So for the old GRAP, if I had something that was not a derivative, I'm not going to go into the explanation of that, but if it really had fixed or determinable payments, I could classify it at amortized cost. So amortized cost just means I work out what the effective interest rate is and I keep adding interest and I calculating payment and do all of those things. Now it's changed. The approach is completely different. So I need to have a look at why I have this instrument firstly, and then if I'm going to collect solely payments of principal and interest. So am I going to collect the capital amount that I gave, plus then the effective interest that I have worked out. The biggest change that we see here in particular is certain loans, particularly concessionary loans. So if your entities do have concessionary loans, you really need to interrogate whether or not they should have moved from amortized cost to fair value. Because if they don't meet either of these two principles, they will need to be at fair value. So a very good example is a concessionary loan where the payments might have been linked to something like a non-financial indicator. So you had certain debt covenants in place, or they had to meet certain performance targets or certain revenue targets. I know here in eThekwini there are some complex arrangements with the ICC, for example, that they didn't need to pay their shareholder unless they had a certain level of revenue. Those are the kinds of things that are non-financial measures, not related to a loan. You know, that's the performance of the entity. So as soon as you start building those things into loan agreements, that's no longer an amortized cost arrangement, that's going to be at fair value. So those are the things that you need to look out for. In terms of changes to impairment, as I said, our old approach, and I always use the example of PP&E because it's easy to understand. Something happens, drive my car into a wall, that's the impairment event. We used to do the same for financial instruments. Somebody didn't pay me, then it was impaired. Or I needed to do an impairment assessment at least. Bearing in mind that impairment is not only if you don't intend to pay at all, if you intend to pay late, it also has a consequence. So although I might have breached the payment, yes, I might still pay you, but I'll pay you only a year from now, or whatever the case might be. But we are moving away from that to say, okay, what's going to be better information for the users is going to be trying to understand what my expected credit loss is going to be. So how many, if I just use an example of an individual debtor, over the next year, how many times do I think they might default? And I need to get an understanding then of what their credit risk and work out what the expected cash flows are going to be and work out what my impairment is. So it's no longer the event, it's actually how many times I think that event could happen going forward, and that's going to be the impairment that I then need to recognize. It needs to be probability weighted, so I can't assume that there's no credit risk. There is credit risk for everyone. Even if it's very small, there must be some sort of probability built into the model as well. So this is going to affect municipalities a lot, because for their debtors, you can understand that there are different services that they have, different payment arrangements. Everything sort of is linked to one particular customer account. Equally with government departments, I think this could also have a big implication, just because we know government departments don't pay one another. I don't know what the credit risk is of the other government departments. You would think it would be good, but it's not at times. So yeah, I think this is really something that's going to be really important for the public sector to get to grips with. And as I said, most of this, you should actually already know most of this, because it's opening balance time now on 1 April 2025. So I'm going to stop there. I think you do have the full extent of the presentation that you can go through. I've tried to highlight a number of resources to you on the website. If you don't already know, as I said, everything is on the website. Please subscribe to our newsletter. We can't do that for you. In terms of the POPI Act, we're not allowed to. But if you want to receive information from us about accounting updates that we might be hosting, about topical accounting issues during audit time, for example, there might be things that come up. And we come to agreement with the trilateral parties and communicate that. Important that you have that information. So register get our newsletter and then follow us on social media. Also have a look at our frequently asked questions. I didn't show that to you, but I assume you know where those are. And then lastly, the Knowledge Hub. I would really urge you to go visit it. Everything is set out nicely. It's not like per standard, it's per, sort of topic, I guess. So non-current assets, liabilities, materiality, etc. So it's a bit more intuitive and I think a lot more user-friendly. But yeah, you'll get the information of the presentation. But yeah, if you need anything from us, you can get us on info@asb.co.za. And thank you, and good luck for your financial statement preparation.